We shall commence this module by studying about the preference shares and debentures. Due to globalization and liberalization of Indian economy, tremendous changes have taken place in Indian financial system. These changes occurred due to reforms measures taken by the Government of India. Some of the reform measures are free pricing of equity shares, entry of FFIs and private sector financial institutions, deregulation of lending rates, option of Indian companies to tap foreign capital markets directly, opening up of banking and insurance industries to the private sectors, etc. All these measures have encouraged Indian capital markets to source the growing needs of term finance requirements of companies both in private and public sector. In capital market, various financial instruments are used to raise capital resources such as common stock, preferred stock and debentures. After studying this module, we will be able to know the meaning and characteristics of debentures, common stock and preferred stock. Then we learn about the different types of debentures. Then we learn about the features of preferred stock. And then finally we will try to understand different types of preferred stock. We have seen the utility and the growth of common stock, preferred stock and debentures. Now we are going to discuss about the meaning of common stock. Common stock is a type of security that represents equity ownership in a corporation. The holders of common stock receives voting rights in the general meeting of the company. They also elect board of directors and formulate policies of the company. They get dividend only after the dividend on all preferred stock are paid in full. At the time of liquidation, common stockholders receive any remaining funds only after all bondholders, creditors and preferred stockholders have been paid. Since common stockholders bear higher risk, they also get a chance to accrue higher dividends if the earnings of the company are higher. Now we are going to see the features of common stock. Following are the features of common stock. Being the owners of the company, common stockholders have a right to control and manage the affairs of the company. However, their control is indirect. They have the right to elect the board of directors and also to vote in the general meeting of the company. Secondly, the holders of the common stock also receive preemptive rights from the company. This means that they can purchase additional shares, namely right issues, on the pro rata basis of their current holdings. These preemptive rights can be renounced or forfeited by them completely or partially. These rights save the existing shareholders from the reduction in the ownership as a result of new equity issues. Third feature of the common stock is the liability of the common stockholders is limited to the extent of the amount of their original investment in the company. The next feature of the common stock is that at the time of winding up or liquidation, common stockholders have residual claim on the assets of the company. They are the last to claim any remaining funds after the claim of the creditors and preference shareholders. All these claims, when they are settled or satisfied, only then these stockholders get anything remaining. In case of insufficient funds at the time of liquidation, value of assets or the claims of common stockholders would remain unpaid. The next feature of the common stockholder is that they receive residual income or profits of the company after all the outstanding claims are satisfied. However, the decision regarding actual amount of cash dividend is taken by the board of directors. They decide what percentage of profit should be distributed as dividend and what percentage should be retained by the company, because the distribution of dividend is not compulsory for the company. If the company wants to distribute the dividend, then only dividend should be distributed. Otherwise, the portion of the profit is saved as retained earnings. The next feature of common stock is that all common stockholders carry right to vote on certain matters in the general meetings of the company, such as electing the board of directors, mergers and acquisitions, stock splits, changes in the company capitalization, etc. We have many advantages associated with the common stock. They are: first, common stock are the permanent resources of the company without any liability of repayment. Secondly, common stocks do not create any obligation on the company to pay fixed rates of dividend. Thirdly, common stocks do not impose any charge on the assets of the company. Fourthly, common stocks provide liquidity to the investors and these are transferable. Fifthly, common stockholders maintain the control and share ownership rights in the income of the company with their limited liability. Apart from advantages associated with the common stock, we have certain disadvantages associated with common stock. They are: first, common stock are not liked by the cautious investors as they are risky. Secondly, as the control of the management is left in the hands of common stockholders, there are chances that the affairs of the company get manipulated. Thirdly, sometimes market value of the equity shares get increased due to higher dividend that results in speculative trading. The fourth is overdose of common stock in the capital structure of the company may lead to overcapitalization. Fifth, the control of existing shareholders may get diluted because of sale of new shares to outsiders. Now we move on to discussion of debentures. Debentures are the creditorship securities issued by the company to raise medium and long-term funds from the public. Debenture holders are the creditors of the company to which company pays interest at fixed rate and the principal amount at the stipulated time. They have no voting rights. As per the terms of issue of the debentures, debenture holders are entitled to redeem their debentures. Now we are going to discuss the features of the debentures. First, debenture has a fixed rate of interest, the repayment of which is compulsorily irrespective of the profit earned. The interest on debenture is tax deductible and is payable semi-annually, quarterly, annually, etc. The second feature is the debentures are generally secured against the present and future immovable assets of the company. The third feature of debenture is that debenture holders have no voting rights in the company in the general meeting of the shareholders. They do not dilute the control of the existing shareholders. The fourth feature of debenture is that company has to create debenture redemption reserve for their redemption of debentures whose maturity exceeds 18 months. The debenture redemption reserve should be equivalent to 50% of the issue or redemption amount before the redemption of debenture commences. The fifth feature of debenture is that company can repay the amount of the debenture to the debenture holders after the specified period. The debentures can be redeemed either by debenture redemption reserve, namely sinking fund, or the call or the put option, or by converting these debentures into equity shares. The sixth feature associated with debenture is that under call or put option, other name is buy or back option, is that company can redeem its debentures before maturity period at a specified price. The call price may be higher than the par or face value, generally by 5%, the difference being the call premium. The put option gives the debenture holder a right to seek redemption and predetermined prices at the specified time. The seventh feature of debenture is that debenture holders are the creditors of the company, not the owners. When an investor, then it appoints a trustee through an indenture or trust deed. Trust deed is an agreement between the trustees, namely financial institutions, banks, insurance companies, firms or attorneys, and the issuing company. In trust deed, description of debentures, rights of issuing company, rights of debenture holders, responsibilities of trustees are specified. The next feature associated with debenture is that debenture holder can convert is debentured into equity shares. The ratio of conversion and the period during which conversion can be affected are mentioned at the time of issue of debenture. The next feature associated with debenture is that all the debentures of the borrowing company must be compulsorily rated by one or more recognized credit rating agencies. Now we are moving on to discuss the types of debentures. We have different types of debentures that can be classified first on the basis of security. Under the basis of security, we have secured or mortgage debentures. These debentures are secured by a mortgage on the assets of the company. These are also known as mortgage debentures. These debentures provide the debenture holder a right to recover their unpaid amount of interest and principal amount out of the assets secured by company. The second type is unsecured or naked debentures. These debentures do not carry any security on the assets of the company. The second type of debentures can be classified on the basis of records. On the basis of record, we have two types of debentures. The first is registered debenture and the second is bearer debentures. These debentures are registered with the company. The interest principal amount of such debentures are payable only to those persons whose name appears in the debenture registers of the company. Such debentures are transferable through transfer deed. They are known as registered debentures. The other type is bearer debentures. These debentures are not recorded in the company register and transferable by merely delivery. The principal amount and the interest is payable to the holder of bearer debenture. The third type of debentures can be classified on the basis of redemption. In this redemption, we have two types of debentures, namely redeemable debentures and non-redeemable debentures. Redeemable debentures are those debentures which can be redeemed after a specified period of time. The principal amount of such debenture is payable at par or premium on the expiry of such period. The redemption of such debenture can be done by annual drawings or purchasing from the open market. The second type is non-redeemable debentures. These debentures are not redeemed over the lifetime of the company. They are rather converted into equity shares or they continue at the time of liquidation of the company. Debentures may be classified on the basis of convertibility. We have two types of debentures, convertible debentures and non-convertible debentures. The debentures which can be converted into equity shares over a period of time are known as convertible debentures. At the time of debenture issue, all the conditions and terms of conversion are announced. Non-convertible debentures. The debentures which are not converted into equity shares of the company are known as non-convertible debentures. Debentures can also be classified on the basis of priority. Under this, we have two types of debentures, namely first mortgage debentures and second mortgage debentures. First mortgage debentures are redeemed in priority to other debentures. The second mortgage debentures are redeemed after the redemption of first mortgage debentures. We have certain advantages associated with debentures. First, debentures are attractive to those investors who prefer safety of the principal and a regular fixed income in the initial years, and after initial years, the benefit of profit in the growth of the company. Secondly, debentures do not carry any voting right, thus they do not dilute the control of the existing shareholders. Thirdly, debentures help the company to trade on equity and thus increasing the return for the shareholders. Fourthly, debentures offer financial flexibility as a company can redeem its debentures whenever it has surplus funds. Fifthly, as interest paid on debentures is tax deductible, thus the company gets the tax benefit by issuing debentures. Sixthly, debenture is a cheaper source of finance because it is cheaper than bank loan and public deposits, because on this the company has to pay interest at a very higher rate as compared to debentures. And ultimately, the debentures can be converted into equity shares and then the company has no need to pay interest. Now we are moving on to discuss the disadvantages associated with debentures. First, a company is required to pay interest every year irrespective of the profits earned, therefore it is more risky. Secondly, debenture holders like secured debentures as they prefer safety of their investment. Therefore, those companies who are not willing to give its assets as security may find it difficult to raise funds through issue of debentures. Thirdly, banks and other financial institutions do not provide funds to those companies whose capital structure is heavily loaded with debentures. Now we move on to understand the meaning of preferred stock. Preferred stock is a hybrid instrument that includes the feature of both an equity and a debt instrument. It is also called preference shares. Preference shares pays fixed periodic dividend payment and like a common stock. It is generally listed on a stock exchange. Preferred stock is senior to common stock but subordinate to bond as a claimant to the income or assets. It has following rights. First, a preferential right to receive a fixed rate of dividend for the entire duration of the company. Secondly, a preferential right to be repaid capital in case of liquidation of the company. Then we have features of preferred stock. The very first is the preferred stock has preference over common stock in the payment of dividend. It means the company must pay the preference dividend in full before the payment of dividend on common stock. When the company goes into liquidation, the preferred stock gets the payment first of all as compared to common stockholder. Thus, preferred stock is less risky than a common stock. The second feature of preferred stock is that preferred stock dividends are fixed and stated as a percentage of par value. These are also known as fixed income security. The third feature of preferred stock is that if the company is not able to pay dividend on its preference stock, then all unpaid dividends are carried forward and paid before any dividend is paid to common stockholders. The next feature associated with preferred stock is that they may be converted into predetermined number of shares over the period of time. Initially, at the time of purchase, conversion rate is set at a rate that is not attractive to the investors. However, if there is an increase in the price of the common stock, investors may convert these stock into common stock and realize an immediate gain by selling it. The next feature associated with it that preferred stock may be participating that allow the holders a chance to participate in additional earnings of the company if any left after the equity and preferred dividends have been paid. They may also allow to participate in the residual assets in case the company goes into liquidation. The next benefit associated with preferred stock is that preferred stocks have no voting rights. An exception to this rule may exist if the preference dividend is in arrear for a considerable period of time. We have different types of preference shares. The very first is cumulative preference stocks. When the dividend is not paid in any particular year, it gets cumulative in the next years, and it is paid first of all as payment to the common stock is known as cumulative preference stock. Furthermore, they will be paid first before paying any dividend to the common stockholder. The second is that non-cumulative preference stocks. Under this type, dividend is not carried forward to the next years. Third is participating stocks. Participating stocks provide the holders an opportunity to receive additional dividend if the company achieves its predetermined financial objectives such as earnings or profitability goals. Those investors who invest in participating stocks receive regular dividend irrespective of the company performance and also receive an extra dividend on the achievement of predetermined goals. These holders get an opportunity to share in surplus assets at the time of winding up of the company. Non-participating stocks. The holders of non-participating stocks are not allowed to receive additional dividends. Then we have redeemable preference stocks. Redeemable preference stocks are redeemed after a specified period of time. Irredeemable preference stocks. These type of preference shares are not redeemed after a period of time. They are redeemed only at the time of liquidation. Then we have convertible preference stocks. The preference shares, those are converted into equity shares after a specified period of time, are known as convertible preference shares. After the conversion of preferred stock into common stock, the change is irreversible and the holder cannot convert the common stock back to preference shares. Non-convertible preference shares. These stocks do not provide any right of conversion to the holders. Then we have advantages of preferred stock. The very first advantage associated with preference stock is that preference stocks are liked by those investors who favor safety of investment and fixed rate of return. Secondly, preference stock carries restricted voting right, thus there is hardly any chance of dilution in control over the company. Thirdly, as the dividend on the preference stock is fixed, they do not impose massive burden on the company. Fourthly, the company is able to raise long-term funds through issue of preference stock without offering its assets as security. The next benefit associated with preference stock is that preference shareholders enjoy stable fixed rate of dividend. We have certain disadvantages associated with preferred stock. First, raising of funds through preference share is expensive as dividend paid on preference share is not tax deductible. Secondly, the creditworthiness of the company may be adversely affected due to the existence of preferred stock. Third, the flexibility of the company may get restricted due to issue of preference stock. Fourthly, there is dilution in the right of the equity shareholders over the assets of the company because of issue of preference shares. Now we are going to make a summary of whatever we have discussed so far. We have started our discussion with the introduction of common stock. Common stock is a type of security that represents equity ownership in a corporation. Then we have discussed that common stockholders have the right to control and manage the affairs of the company. However, their control is indirect. Then we have discussed debentures. Debentures are creditorship securities issued by the company to raise medium and long-term funds from the public. Then we have discussed the classification of debentures. Debentures are classified on the basis of redemption record, convertibility, redemption, and priority. Then we have seen the meaning of preferred stock, or in simple words we can say preference shares. Preferred stock is a hybrid instrument that includes the features of both an equity and a debt instrument. Then we have seen the different types of preference shares such as cumulative, non-cumulative, participating, non-participating, redeemable, non-redeemable, convertible, non-convertible. Then we have seen the advantages and disadvantages associated with common stock, debentures, and preference shares. And we see that all these are long-term sources of finance for the company, and company can rely on the mix of all these sources.